39-year-old Richard Young bought his first home 4 years ago. And as interest rates started to rise, the banking professional refinanced his home, not once, but twice, in a short span of just 2 years.
When I first bought my house in 2016, I was on a fixed rate of 1.85% for 2 years. After that 2 years lock-in period was up, I refinanced that, and that was at 1.65%, not fixed. This lasted until January 2019, when the rate spiked to 2.18% because of the increase of the in-house board rate. And I subsequently refinanced in November 2019 to a rate of 1.89% fixed for the first year.
For many homeowners like Richard, switching to a cheaper loan package means more cash on hand.
This resulted in quite a significant of $400 to $500 in terms of mortgage fees per month. Extra savings definitely go a long way in terms of from a cost of living, be it from house maintenance, as well as given the COVID situation, there's more working from home, higher utility bills.
Uncertainty over the COVID-19 situation has seen central banks across the world, like the US Fed, slash rates to boost economic growth. Here in Singapore, we have also seen a decline in the Singapore Interbank Offered Rate, or SIBOR, which historically tracks US Fed rates.
A year ago, the Sing dollar 3-month SIBOR was at 2%. By refinancing it today, you are likely to save about 60 to 70 basis points as compared to 1 year ago. And that 70 basis point would translate to $7,000 per year from a loan outstanding of $1 million. So that is very substantial.
Generally in the market, there are two types of interest rate structures. There's the fixed rate, and when we talk about fixed rate, it basically means that you're fixed to a certain interest rates for a lock-in period. And floating rates can either be pegged to a transparent benchmark like the 3-month SIBOR or the SOR rate, but it's subject to greater volatility in the sense that when it changes every 1 or 3 months, your monthly repayments will also fluctuate accordingly. It can also be pegged to the board rate or fixed deposit rate, and these are usually less transparent.
Analysts say that with interest rates expected to stay lower for longer, floating rate packages tied to SIBOR look attractive. The dip in interest rates also gives Richard yet another opportunity to rework his current mortgage.
This time round, I would not refinance because I have chosen a mortgage loan that allows me to do a repricing. This allows me to reprice from a fixed rate after the first year, and I may consider a floating rate with the same bank. Clearly, with low interest rate environment, a floating rate today is very attractive.
Unlike refinancing, repricing allows homeowners to switch to a more competitive loan package within the same institution.
If you refinance, you're switching to a different bank. If you reprice, you're switching to a different loan package within the same bank. Now, refinancing might cost you around $2,500 to $3,000 in conveyancing fees, for example. That's not including other costs. Repricing might only cost around $500 to $800.
Repricing may also help you save time on the paperwork.
With repricing, you don't have to go through the whole hassle of a credit assessment, pay your legal fees and valuation fees, as well as any lock-in fees that you might be liable for.
And if your job situation has changed, repricing may be a safer bet.
When you do refinance, the bank will again look through your background. They'll want to see your pay slips. They'll want to do a valuation of the property. There is a chance, if your financial situation has changed, that you may not be able to get the same kind of loan that you had before, if you're earning less, for example.
When shopping for a new mortgage, homeowners need to work out the figures for themselves, especially those still in the lock-in period. This is because breaking a loan during the lock-in period could invite hefty penalties, which means reduced savings. For example, if you just took up a $700,000 loan over 25 years at an interest rate of 1.55%, the interest you will pay over the total loan tenure is $140,000. If you reprice with the same institution at 1.35%, total interest payable drops to $125,000. That's a potential savings of $15,000. Let's say you find another institution willing to give you an even lower interest rate of 1.25%. Total interest payable drops further to $116,000. However, because you're still within the lock-in period, you will be subjected to a repayment fee of 1.5% of the outstanding loan. Include valuation and legal fees. This brings your total refinancing cost to $13,000, giving you net savings of just $11,000. Therefore, in this instance, repricing may offer better savings.
So for the first time I refinanced, that is post the 2-year lock-in period, I was not impacted. The second time I refinanced, I was impacted by the lock-in period. However, the terms and agreement of my refinancing mortgage loan allows me to exit that with minimal penalties from the second refinancing. And given the interest rate environment back then have drastically changed and was on upward trend, it made commercial sense to bite that bullet still and refinance, and I'm better off financially in the longer run.
Experts say whether you choose to reprice or refinance your home loan, it's important to first do your sums before committing to a new mortgage.